On December 15th, 2025, the Federal Reserve announced its final interest rate decision of the year, maintaining rates at 4.75%, while signaling cautious optimism about inflation trends and employment stability. To most observers, this appeared as routine monetary policy, a technical adjustment by seasoned economists managing the world's largest economy. Financial markets responded with modest gains, technology stocks continued their upward trajectory, and consumer confidence remained elevated. Yet this seemingly ordinary moment represented something far more significant, the culmination of nearly 15 years of extraordinary monetary intervention that had fundamentally altered the relationship between asset prices and economic reality. The roots of this transformation trace back to the 2008 financial crisis, when the Federal Reserve embarked on an unprecedented experiment in monetary policy. Following the collapse of Lehman Brothers and the subsequent credit freeze, central bank officials implemented quantitative easing on a scale never before attempted in American economic history. Between 2008 and 2014, the Fed's balance sheet expanded from approximately $900 billion to over $4.5 trillion, injecting liquidity directly into financial markets through systematic purchases of treasury bonds and mortgage-backed securities. This monetary expansion achieved its immediate objectives. It stabilized financial markets, prevented a complete economic collapse, and facilitated a gradual recovery in employment and GDP growth. However, it also created unintended consequences that would compound over the following decade. Asset prices began to decouple from traditional valuation metrics as investors, facing near zero interest rates, moved capital into riskier investments, seeking higher returns. Stock markets, real estate, and corporate bonds experienced sustained appreciation that far exceeded underlying economic growth. The COVID-19 pandemic in 2020 accelerated these trends dramatically. Congress approved stimulus packages totaling approximately $5.2 trillion between March 2020 and March 2021, while the Federal Reserve once again expanded its balance sheet, this time reaching $9 trillion by early 2021. These interventions prevented economic collapse during lockdowns, but they also injected unprecedented liquidity into an economy with severely constrained production capacity. The result was a surge in asset prices across virtually every category. Stocks, bonds, real estate, commodities, and even digital assets reached valuations that historical precedent suggested were unsustainable. By late 2025, the cumulative effects of these policies had created what economists increasingly recognized as a fundamental distortion in price discovery mechanisms. The S&P 500 index, which stood at approximately 676 in March 2009, had reached over $6,000 by December 2025. A nearly ninefold increase that far exceeded the economy's underlying growth in productivity, employment, or GDP. Technology companies, particularly those involved in artificial intelligence development, commanded market capitalizations that implied future revenue streams requiring sustained growth rates of 25-30% annually for multiple decades. Corporate debt levels had also reached historically unprecedented levels. According to Federal Reserve data, non-financial corporate debt exceeded $12 trillion by the end of 2025, representing approximately 47% of GDP, the highest ratio in American economic history. Much of this borrowing had been used not for productive investment in equipment, research, or expansion, but for share buybacks and dividend payments that artificially inflated stock prices. Companies had effectively borrowed against future earnings to reward current shareholders, creating a dynamic that required perpetual growth in both revenue and access to credit markets. Real estate markets exhibited similar distortions. The median home price in the United States had increased from approximately $200,000 in 2009 to over $420,000 by late 2025, despite stagnant median household incomes when adjusted for inflation. This appreciation reflected not underlying improvements in housing quality or construction costs, but rather the availability of cheap credit and speculative investment activity encouraged by monetary policy. Perhaps most concerning was the development of what financial analysts termed consensus complacency, a widespread belief among investors, policymakers, and economists that the combination of technological innovation, monetary flexibility, and global economic integration had effectively eliminated the possibility of severe economic downturns. This perspective, while understandable, given the sustained period of market appreciation, ignored fundamental principles of economic cycles that had operated consistently throughout American financial history. Historical analysis reveals that every major economic expansion in American history has eventually encountered constraints that forced corrections in asset prices and economic activity. These constraints typically involve some combination of excessive leverage, misallocated capital, monetary tightening, or external shocks that expose underlying vulnerabilities. The expansion following 2009 had lasted 16 years by 2025, longer than any previous cycle in recorded American economic history, suggesting that accumulated imbalances had reached extraordinary levels. The specific vulnerabilities emerging by late 2025 centered on three interconnected factors: unsustainable asset valuations supported by cheap credit, corporate leverage ratios that assume perpetual access to favorable borrowing conditions, and consumer spending patterns dependent on continued appreciation in investment portfolios and real estate values. Each of these factors reinforce the others, creating what economists recognized as a potentially unstable equilibrium that could shift rapidly if market sentiment or economic conditions changed. As 2025 concluded, sophisticated financial institutions and economic research organizations had begun publishing analyses suggesting that the combination of these factors created conditions similar to those preceding previous major economic corrections. The specific timing and magnitude of any potential downturn remained unknowable, but the structural conditions appeared increasingly reminiscent of patterns that had preceded significant wealth destruction in American economic history. The artificial intelligence boom that dominated financial markets throughout 2024 and 2025 represented the most significant technological investment bubble since the dot-com era of the late 1990s. By December 2025, companies with AI in their business descriptions commanded market premiums that defied traditional valuation metrics, while venture capital funding for artificial intelligence startups exceeded $180 billion annually, more than the entire GDP of many developed nations. This phenomenon occurred not through speculative excess alone, but through systematic corporate restructuring that fundamentally altered how American businesses allocated capital and resources. The transformation began in earnest, following the public release of advanced language models in late 2022. Corporate executives, facing pressure from investors to demonstrate AI integration strategies, initiated massive capital expenditure programs focused on data infrastructure, specialized computing hardware, and AI talent acquisition. Technology giants like Microsoft, Google, Amazon, and Meta allocated combined annual spending exceeding $200 billion specifically for AI-related investments, representing the largest coordinated technology deployment in corporate history. This spending created immediate economic effects that appeared overwhelmingly positive. Employment in technology sectors reached record levels as companies competed for engineers, data scientists, and AI specialists. Average salaries for AI-related positions exceeded $180,000 annually by 2025, contributing to increased consumer spending in major metropolitan areas. Stock prices for companies announcing AI initiatives experienced sustained appreciation, creating substantial paper wealth for investors and employees holding equity compensation. However, underlying these apparent successes were concerning patterns that historical analysis suggested were unsustainable. Corporate spending on AI infrastructure was occurring largely through debt financing rather than current cash flow. Many companies issued bonds or secured credit lines specifically to fund AI transformation initiatives, betting that future productivity gains would justify current expenditures. This represented a fundamental shift in corporate finance strategy. Instead of investing in proven technologies with predictable returns, American businesses were borrowing against speculative future benefits from technologies still in development. The productivity statistics told a more complex story. Despite unprecedented investment in AI technology, measured productivity growth in the American economy remained modest throughout 2024 and 2025. The Bureau of Labor Statistics reported annual productivity increases of approximately 2.1% during this period, higher than the previous decade, but substantially below what economic theory suggested should result from transformative technological advancement. This disconnect between investment levels and productivity outcomes resembled patterns observed during previous technology bubbles, when massive capital allocation failed to generate proportional economic returns. Energy consumption requirements for AI infrastructure created additional economic pressures that were becoming apparent by late 2025. Data centers supporting large language models and AI training required electricity consumption equivalent to medium-sized cities. Google reported that its AI operations consumed approximately 15% more electricity in 2025 compared to 2023, while Microsoft's energy usage increased by 23% during the same period. This increased demand contributed to rising electricity costs for businesses and consumers, particularly in regions with concentrated data center activity. The concentration of AI investment among a relatively small number of technology companies created systemic risks that economists increasingly recognized as problematic. 7 companies, Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia, represented approximately 32% of the total S&P 500 market capitalization by December 2025. These companies' stock prices had become highly correlated with investor sentiment about AI technology, meaning that any significant change in AI market expectations could trigger substantial wealth destruction across broad market indices. Nvidia's trajectory exemplified both the opportunities and risks inherent in the AI investment boom. The company's stock price increased from approximately $180 in January 2023 to over $950 by December 2025, representing a market capitalization exceeding $2.3 trillion. This valuation implied that NVIDIA would need to maintain profit margins and growth rates that had never been sustained by any technology company in history. The company's graphics processing units had become essential infrastructure for AI development, creating temporary monopolistic pricing power that supported extraordinary profit margins. Yet historical precedent suggested that such monopolistic positions in technology markets were typically temporary. Previous technology cycles had demonstrated that initial market leaders often faced competition from alternative technologies, regulatory intervention, or changes in customer requirements that rapidly eroded pricing power. Intel's dominance in microprocessors during the 1990s, Cisco's networking equipment monopoly during the early Internet era, and various software platform advantages had all proven transitory despite appearing permanent at their peaks. Corporate debt levels specifically related to AI investment had reached concerning proportions by late 2025. Technology companies had issued approximately $340 billion in bonds during 2024 and 2025, much of it earmarked for AI infrastructure development. This borrowing occurred during a period of relatively favorable interest rates, but it created fixed obligations that would persist regardless of whether AI investments generated expected returns. Companies were essentially borrowing against future AI productivity gains that remained hypothetical rather than proven. The AI workforce expansion also created potential vulnerabilities. Technology companies had hired aggressively, increasing total employment in AI-related positions by approximately 340% between 2023 and 2025. These hiring patterns assumed continued growth in AI market demand and sustained corporate willingness to invest in experimental technologies. Historical analysis of technology employment cycles suggested that such rapid workforce expansion often proved unsustainable when market conditions changed or investor sentiment shifted. Consumer behavior had also adapted to assume continued AI-driven economic growth. Household spending patterns in technology, intensive metropolitan areas reflected confidence in sustained high-income employment and continued appreciation in technology stock portfolios. Consumer debt levels in these regions increased substantially during 2024 and 2025 as individuals leveraged expected future income growth to support current consumption patterns. International competition in AI development added geopolitical dimensions that could rapidly alter market dynamics. Chinese technology companies were pursuing parallel AI development strategies with substantial government support, while European regulators were implementing AI governance frameworks that could restrict American companies' operations in those markets. These factors introduced regulatory and competitive uncertainties that could significantly impact the profitability and growth trajectories that supported current AI company valuations. By December 2025, the combination of these factors had created what economists recognized as a potentially unstable configuration. Massive corporate debt loads, justified by speculative future returns, concentrated market risks in a small number of highly valued technology companies, and consumer spending patterns dependent on continued AI sector employment growth. This structure required sustained success across multiple uncertain variables simultaneously, a requirement that historical precedent suggested was unlikely to be fulfilled indefinitely. The global financial architecture that emerged in the aftermath of the 2008 crisis had, by 2025, created an unprecedented level of interconnectedness between American monetary policy and international markets. When Federal Reserve officials made their routine December 2025 rate decision, the implications extended far beyond domestic considerations, influencing currency values, sovereign debt markets, and economic stability across every major economy. This interconnectedness, while facilitating global growth during favorable conditions, had simultaneously created transmission mechanisms that could amplify economic shocks with extraordinary speed and magnitude. The dollar's role as the world's primary reserve currency had become even more pronounced during the post-2008 period. Approximately 60% of global foreign exchange reserves were denominated in dollars by 2025, while an estimated $13 trillion in debt securities issued by non-American entities were dollar-denominated. This meant that changes in American interest rates, dollar exchange rates, or American economic conditions directly affected the financial stability of governments, corporations, and financial institutions worldwide, regardless of their domestic economic fundamentals. Emerging market economies had become particularly vulnerable to American monetary policy shifts. Countries, including Turkey, Argentina, Brazil, and South Africa, had accumulated substantial dollar-denominated debt during the period of low American interest rates following 2008. Turkish corporations alone held approximately $180 billion in foreign currency debt by 2025, representing nearly 25% of the country's GDP. When American interest rates rose, or the dollar strengthened, these debt burdens increased automatically, straining corporate balance sheets and government fiscal positions. China's economic relationship with the United States had evolved into a complex interdependence that created systemic risks for both economies. Despite ongoing trade tensions and strategic competition, Chinese institutions held approximately $780 billion in United States Treasury securities by late 2025, while Chinese exports to the United States exceeded $450 billion annually. American companies had invested over $120 billion in Chinese manufacturing capacity and supply chains, creating operational dependencies that could not be rapidly restructured. Any significant disruption in Chinese economic growth or Chinese financial markets would immediately affect American corporations, consumers, and financial institutions. The European Central Bank had followed American monetary policy throughout the post-2008 period, implementing its own quantitative easing programs and maintaining negative interest rates for extended periods. European banks held substantial positions in American asset markets, while American financial institutions had significant exposure to European sovereign debt and corporate securities. The total cross-border financial claims between American and European institutions exceeded $4.2 trillion by 2025, meaning that financial stress in either region would rapidly transmit to the other. Japanese economic policy had become particularly dependent on American monetary conditions. The Bank of Japan maintained its yield curve control policy partly to prevent excessive yen appreciation against the dollar, which would damage Japanese export competitiveness. Japanese institutions held over $1.1 trillion in American Treasury securities and had substantial investments in American corporate bonds and equities. The Japanese Government Pension Investment Fund, the world's largest pension fund, had approximately 40% of its assets invested in foreign securities, predominantly American markets. Global supply chain integration had created additional transmission mechanisms for economic shocks. American corporations sourced approximately $2.8 trillion worth of intermediate goods and raw materials from international suppliers in 2025, while exporting $1.9 trillion in goods and services to international markets. These trade relationships were supported by complex financing arrangements, including letters of credit, trade financing, and currency hedging contracts that could rapidly destabilize if confidence in American economic stability declined. The international energy market represented another critical vulnerability. Global oil prices remained denominated in dollars, meaning that changes in dollar values directly affected energy costs worldwide. American shale oil production had made the United States the world's largest oil producer by 2025, contributing approximately 19 million barrels per day to global supply. Any significant economic disruption that affected American energy production could trigger international energy price volatility with immediate economic consequences for every major economy. Commodity markets had become increasingly financialized during the post-2008 period, with investment funds and financial institutions holding substantial positions in agricultural products, metals, and energy futures. These positions were often leveraged and could be rapidly liquidated during periods of financial stress, potentially causing commodity price volatility that would affect food costs and industrial inputs globally. American financial institutions held approximately 35% of total commodity derivatives positions by 2025, meaning that American financial sector stress could trigger international commodity market disruptions. The international banking system had developed structural dependencies on American dollar funding markets. European and Asian banks regularly accessed American money markets to finance their operations, borrowing approximately $1.4 trillion in short-term dollar funding daily through repurchase agreements and commercial paper markets. This funding was essential for international banks' ability to support trade finance, corporate lending, and normal banking operations. Any disruption in American financial markets could immediately constrain international banks' access to dollar funding, potentially triggering credit contractions in multiple countries simultaneously. Currency carry trades had become a significant source of international financial instability. Investors borrowed in low-interest rate currencies, particularly the Japanese yen and Swiss franc, to invest in higher-yielding assets in emerging markets and American technology stocks. The total value of currency carry trades was estimated at over $2 trillion by late 2025, creating leveraged positions that would need to be unwound rapidly if market volatility increased or interest rate differentials changed. Historical precedent demonstrated that carry trade unwinding could trigger cascading financial instability across multiple currencies and asset classes. Sovereign wealth funds and pension systems worldwide had increased their allocations to American equity markets during the post-2008 period, seeking higher returns than were available in domestic markets or government bonds. Norwegian Government Pension Fund Global, Singapore's GIC, and similar institutions had approximately 65% of their assets invested in international markets by 2025, with substantial concentrations in American technology stocks and real estate. These institutions managed over $45 trillion in assets globally, meaning that any significant decline in American asset values would directly affect retirement security and government finances in multiple countries. The derivatives, markets that connected international financial institutions, had grown to extraordinary proportions. The Bank for International Settlements estimated that notional outstanding derivatives contracts exceeded $610 trillion by 2025, with American institutions serving as counterparties to approximately 40% of these positions. These contracts included interest rate swaps, currency hedges, and credit default swaps that allowed risk transfer, but also created complex webs of interconnected obligations. During periods of financial stress, these derivative relationships could amplify shocks as institutions struggled to meet margin calls and collateral requirements simultaneously. Central bank coordination mechanisms that had been developed following previous financial crises remained in place, but they had not been tested during a period of synchronized global economic stress originating in American financial markets. The Federal Reserve maintained swap line agreements with major central banks, allowing them to provide dollar liquidity to their domestic financial institutions during emergencies. However, these arrangements assumed that the Federal Reserve itself would remain financially stable and capable of expanding its balance sheet to support international liquidity needs. By December 2025, this interconnected global financial architecture had created conditions where any significant disruption in American financial markets would rapidly transmit to international markets through multiple simultaneous channels: currency markets, commodity prices, trade, finance banking relationships, and investment portfolio losses. The speed and magnitude of potential transmission had increased substantially compared to previous decades due to electronic trading, algorithmic investment strategies, and the increased scale of cross-border financial relationships. The accumulation of systemic vulnerabilities throughout the American financial system by late 2020 had created what economists increasingly recognized as a person of fragility paradox, a situation where apparent stability and prosperity masked underlying structural weaknesses that could produce rapid and severe economic corrections. Historical analysis of major financial crises revealed consistent patterns. Periods of sustained growth and low volatility typically preceded the most severe economic contractions, as market participants became complacent about risks and accumulated leverage that proved unsustainable when conditions changed. Consumer debt levels had reached historically unprecedented proportions across multiple categories. Total household debt exceeded $18.2 trillion by December 2025, representing approximately 75% of GDP, the highest ratio in American economic history. Credit card debt alone surpassed $1.4 trillion, with average interest rates exceeding 21% annually. Mortgage debt totaled over $13 trillion, much of it secured by property values that reflected 15 years of artificial appreciation driven by monetary policy rather than underlying economic fundamentals. Auto loans exceeded $1.8 trillion, with average loan terms extending to 84 months, and loan-to-value ratios often exceeding 120% of vehicle values. These debt levels were sustainable only under conditions of continued employment growth, stable interest rates, and ongoing appreciation in asset values that supported consumer confidence and spending. However, each of these conditions depended on factors that historical precedent suggested were cyclical rather than permanent. Employment growth had been concentrated in sectors that were particularly sensitive to economic downturns, including professional services, technology, and discretionary consumer spending. Interest rates remained historically low, but were subject to Federal Reserve policy decisions that could change rapidly in response to inflation or financial stability concerns. Corporate financial structures had become similarly dependent on favorable conditions that could not be guaranteed to persist. Share buyback programs had reached unprecedented levels, with S&P 500 companies repurchasing approximately $950 billion worth of their own stock during 2025. These buybacks were funded primarily through debt issuance rather than excess cash flow, meaning that companies were borrowing money to artificially inflate their stock prices. This strategy created short-term benefits for shareholders and executives with equity compensation, but it also increased corporate leverage and reduced financial flexibility for responding to economic downturns. Private equity and venture capital markets had accumulated approximately $4.2 trillion in committed capital by late 2025, representing funds that investors had promised to deploy but had not yet invested. This dry powder created pressure for continued deal-making at elevated valuations, as fund managers faced contractual obligations to deploy capital within specified timeframes. The competition for attractive investment opportunities had driven purchase price multiples to levels that required sustained revenue growth and margin expansion that were difficult to achieve in slowing economic conditions. Real estate markets exhibited characteristics that historically had preceded significant corrections. Commercial real estate values, particularly office buildings in major metropolitan areas, had become disconnected from underlying rental income streams as remote work patterns permanently altered space requirements. Many office buildings in cities, including San Francisco, Seattle, and New York, were experiencing occupancy rates below 60%, yet their assessed values reflected pre-pandemic usage assumptions. Commercial real estate debt exceeded $5.6 trillion by 2025, much of it secured by properties whose income-generating capacity had been permanently impaired. Regional banking institutions faced particular vulnerabilities related to commercial real estate exposure and interest rate risk. Approximately 65% of commercial real estate loans were held by banks, with assets below $250 billion, meaning that property value declines would disproportionately affect smaller institutions that lacked the diversification and capital buffers of major banks. These banks also held substantial portfolios of long-term securities, purchased during the low interest rate environment, creating unrealized losses that would become problematic if deposit outflows forced asset sales. The insurance industry had developed dependencies on continued low interest rates and stable asset values that created potential systemic risks. Life insurance companies had made long-term policy commitments, assuming they could invest premiums in assets, yielding adequate returns to fund future claims. As traditional safe investments like government bonds offered minimal yields, insurance companies had increased their allocations to corporate bonds, real estate, and alternative investments. By 2025, the insurance industry held approximately $8.4 trillion in assets, much of it invested in securities that could experience significant value declines during economic stress periods. Pension systems, both public and private, faced similar challenges on an even larger scale. State and local government pension systems reported total assets of approximately $5.2 trillion by late 2025, but many of these systems remained underfunded despite years of strong market returns. Public pension systems typically assumed annual investment returns of 7 to 7.5% to meet their long-term obligations, requiring continued strong performance in both stock and bond markets. Corporate defined benefit pension plans held an additional $3.1 trillion in assets and faced similar return requirements to fund retirement benefits for current and former employees. The financial technology sector had introduced new forms of systemic risk that were not well understood or regulated. Digital payment systems processed approximately $180 billion in transactions daily by 2025, while cryptocurrency markets had reached a total value exceeding $2.8 trillion. These systems operated with minimal regulatory oversight and could experience rapid destabilization during periods of broader financial stress. The interconnections between traditional financial institutions and fintech companies meant that disruptions in digital payment systems or cryptocurrency markets could affect conventional banking operations. Algorithmic trading and electronic market making had become dominant forces in financial markets, executing approximately 85% of equity trading volume by 2025. These systems operated effectively during normal market conditions, but could amplify volatility during periods of stress as algorithms responded to price movements and market signals in coordinated ways. The flash crashes that had occurred periodically during the previous decade demonstrated how electronic trading could produce rapid and severe price movements that were disconnected from underlying economic fundamentals. International economic conditions were simultaneously deteriorating in ways that could trigger or amplify American financial stress. Chinese economic growth had slowed substantially, with official GDP growth rates declining to approximately 3.2% annually by late 2025. The lowest sustained growth rate since the 1970s. European economies faced persistent inflation pressures and energy security concerns related to ongoing geopolitical tensions. Japanese demographics continued to constrain economic growth, despite massive fiscal and monetary stimulus programs. The convergence of these domestic and international vulnerabilities had created conditions that economists recognized as inherently unstable. Small disruptions in any component of this interconnected system could trigger cascading effects that would rapidly spread throughout domestic and international financial markets. The specific nature and timing of potential triggering events remained unpredictable, but historical analysis suggested that such events typically emerge from unexpected sources rather than widely anticipated risks. Market participants and policymakers had generally dismissed concerns about systemic instability, pointing to strong employment statistics, corporate earnings growth, and the absence of obvious speculative excesses similar to those that had preceded previous financial crises. However, this confidence itself represented a characteristic feature of late-cycle market conditions, when accumulated imbalances had reached levels that required only minor disruptions to produce major corrections. The potential magnitude of wealth destruction from any significant market correction had reached unprecedented levels due to the absolute scale of asset values and leverage throughout the financial system. Conservative estimates suggested that a 40% decline in equity markets combined with 20% declines in real estate values could eliminate approximately $35 trillion in household wealth, equivalent to nearly 150% of annual GDP. Such wealth destruction would immediately affect consumer spending, corporate investment, tax revenues, and pension funding, creating economic contraction that would extend far beyond financial markets into employment, production, and international trade. As 2026 began, the American economy presented the appearance of strength and stability while containing structural vulnerabilities that historical precedent suggested could produce rapid and severe corrections. The specific catalyst and timing of any potential crisis remained unknown, but the underlying conditions had reached levels that economists recognized as inherently unsustainable and potentially explosive. The critical question was not whether corrections would occur, but rather whether they would develop gradually enough to allow orderly adjustments, or would manifest as the sudden and severe wealth destruction that had characterized previous major financial crises throughout American economic history.